Welcome to this week's episode of Mayhem in the Markets, coming to you Monday, September 4th, 2023, and brought to you by MacroVisor, where we make macro actionable, and TraderAid, where we help you find your trading edge. On screen, we have stock valuations diverging meaningfully from real yields. Does this suggest perhaps that we're starting to see a little bit more resilience against higher interest rates in the stocks that have led the rally higher, the ones whose forward PE ratio has been stretched the most? Or, indeed, is this telling us something a little bit different, that stocks and other assets that are risk proximal have diverged so meaningfully from rates that perhaps there's an eventuality here that they need to catch down because there are alternatives in safer areas of fixed income, and one need not take risk in equities that in many parts of the market might be abundantly overvalued. It's at least something to think about with what we're seeing here. This year-on-year change between U.S. tech stocks and U.S. TIPS yields is another divergence, which again could either suggest that stocks are becoming very resilient to high and rising interest rates, or that perhaps eventually these things need to catch down. Now, often when I post the chart of QQQ versus TLT or the NASDAQ composite versus the 10-year note price, folks ask, can I go back farther? I typically show a 2 or 3 year period because it illustrates how strong that correlation is over a time frame that everyone's familiar with. But you can take these same correlations, like the one on screen here, which is very similar, back decades, and they hold relatively strong throughout those periods of time. In fact, the majority of the stock market tends to benefit from dropping rather than rising interest rates. Nevertheless, the largest 10% of U.S. companies within the S&P 1500 have shrugged off rising rates. Now, again, this may speak to the resilience that we're seeing. A lot of these companies have pushed off their financing requirements years into the future, and when they did their refinancing of corporate debt, they did so at a time where rates were appreciably lower than they are now. So on the long end, they're now paying less than they're earning on the short end on their cash that's parked in bills. Pretty good arrangement. Nice work if you can get it. Helps to make them more resilient from a rising rate environment. In fact, in some ways, they benefit if they manage their books well. Coming up this month, it's the riskiest month in history. Going back to data that started in January of 1928, sampled by S&P Global, September had negative returns 55% of the time, with an average drawdown of 1.1%. Even if you just take a 20-year sample period, you still see that September is down about half the time, with an average loss of about 0.5%. Why does this all matter? Because the first 2 weeks of September tend to be rather difficult, and yet we have some offsets here. We have rising skew, flows may be more supportive. We also have an environment where there's buybacks coming in. These are areas that I covered on this week's Navigating the Markets that was given to TraderAid members. If you'd like to learn more about that work, where every week I spend time digging into the details of the economy, the market, the sentiment, positioning, the flows, and everything else, check it out. It's about a 10 to 15 minute read every week, full of charts from all around the world, focusing on what's going on in the big picture and drilling into some of the greater details underneath. Whoa, Canada. Look at that price of housing, eh? This is a pretty incredible chart. It speaks to a lack of supply, a market where there's a lot of foreign investment, and this is something that may not end well for a lot of folks that have bought in within the last several years. But nevertheless, this is a market that is on fire, and it makes what we're looking at in the United States and in other Western countries tame in comparison, right? You can see how even though the United States has had this resilient recovery in housing, Canada just puts that all to shame and then some. Nevertheless, buying a house in the United States is really expensive. In fact, it costs almost about $1,000 a month more to buy a house than to rent a house, which leads us to the next chart here. The Goldman Sachs Housing Affordability Index shows all-time lows. All-time lows. So many people are priced out of the American dream here, unable to buy a house because, quite frankly, they can't afford the principal price, the mortgage, the property taxes, the insurance, everything that goes into it, the inflated bills for services, and then all the increased cost of living. Many people are simply priced out of the housing market. And yet we have near all-time high number of realtors. So there's a bubble in housing, right, in the price, while mortgage applications are at lows we haven't seen in, I think it's about 28 years, going back to 1995. And rates are as high as they were in 2001. And yet in 2001, look at how many realtors there were. In 1995, look at how many realtors there were. Just giving a sense as to just how overpopulated this industry is right now. And I get it. For a while, it worked really well. But now that we're in this structural downturn in housing, and I know it doesn't seem like it because prices are hitting highs in many areas, but it's a downturn because the activity, the sales, the demand has plummeted. And that means the number of commissions that realtors are making, you guessed it, also dropping quite a bit. The price of everything that we need tends to go up, whereas the price of things that are a little more discretionary in nature, well, they tend to go down. They tend to be deflationary. Interesting to note that hospital services and college tuitions and medical care tend to outpace the rate of inflation by 2 to 3-fold. Childcare is right up there with it. Food and bev, housing, they're rising parabolically now, something that many American families have had to experience over the last several years, and this is why it is so unaffordable. New cars also extremely unaffordable. In fact, one expert says it is the least affordable car market in modern history. And Americans owe $1.75 trillion in student debt, which is significant. I know this chart puts us at 2021. You go to March of 2023, it's at 1.77 trillion. Still accurate then. It's too much. People are not getting enough for what they're paying for. Student debt is also disadvantageous because those that owe it cannot discharge it in bankruptcy court, which is a huge problem. Something that should be addressed. The number of millionaires has skyrocketed in the United States between 2000 and 2022, but it means a lot less to be a millionaire now than it did then because of the depreciated purchasing power of the currency from so much more being brought into existence, so much spending, and particularly now we've had this huge asset bubble as well. And this is one of the reasons that we've had inflation is you've got so many people that have so much to spend, after this large amount of stimulus that was pumped into the system. And now we have, unfortunately, the greatest wealth disparity that we've seen generationally and a couple of other metrics since the Great Depression, really. Now on screen, we can see millennials versus silent generation, baby boomers, and Gen X. Silent generation, we can see they're drawing down their retirements. Baby boomers are continuing to amass wealth. Gen X is continuing to amass wealth, but millennials are pretty flat here. And my observation is because they haven't been able to participate in the housing market, they haven't realized what is often the largest asset in every American's net worth, and that is their home. Without that appreciation, they've been largely left behind. The top 10% also owns 70% of U.S. wealth, with the bottom 90% having less and less and less over the last 21 years on this chart. This is a big problem. And again, it is the widest disparity since what led up to, I should say, the Great Depression. The Great Depression corrected that disparity. I'm not saying the same outcome is happening here and now. I don't think that that's the exact scenario that plays out. But it's something that definitely puts a lot of pressure on our society because there's all too many people that simply cannot afford their cost of living, while others have too much money and they don't even know what to do with it, realistically speaking. And this is where it gets a little bit sad. 40% of US adults have less than $1,000 of savings, with 12% saying $0, 27% saying less than $1,000. And I know this chart doesn't add up to 100%. That is because some respondents responded with, I don't know, or I don't have a reply. This is a pretty disheartening set of statistics here. And it shows you just how disparate things are when we've had this surge of millionaires over the last 22 years, and yet 40% of US adults have less than $1,000 in their bank. And pay is not always correlated to performance. At least it may not be when it comes to CEO pay. Going back over, let's call it the last 15 years or so here, we can see that lower paid CEOs actually outperformed their higher paid counterparts. How about that? Maybe someone ought to tell Google. And the top state marginal income tax rates, well, it's no wonder that people want to leave California or New York. And look, I get there's more to it than just the marginal tax rate. Okay, this chart is meant to be a little bit fun because the meme is everyone's moving to places like Texas, Florida, Tennessee, etc. because they have no taxes, at least at the income level. But Tennessee also, apparently, what I'm hearing is they have no property tax either, which is pretty darn interesting. Seems one reason that folks might want to retire in a state like that. And tighter consumer loans point to weaker payrolls, something that illustrates the power of the consumer, 2/3 of the U.S. economy. When you curtail debt to them, well, the knock-on impacts are broad, and it ends up sadly hurting more consumers as they lose their jobs. And this is an issue because we can see those same consumer loans are increasing in the number of delinquencies. And what does that mean? It means that credit conditions will likely tighten further, which will push up more unemployment and reduce payrolls, right? So we can see we're on this trajectory here where the claims by states are similar leading up to prior recessions. And that is to say that there's been an increasing number of U.S. states with sharply rising year-over-year unemployment claims. And this is nearly 30%. It matches the trajectory we've seen leading up to these other types of recessionary environments where you get this all of a sudden very big move higher in unemployment claims. I'm not saying that has to come next, but the weakness in the labor market we're seeing, if the services industry goes into a multi-month contraction, if jobless claims start pushing above 300K a week and unemployment over 4% and rising, I think that this scenario is very likely. I am not buying soft landing consensus. I haven't the entire time it's been out there. I think it's a bunch of feel-good nonsense. I understand why people would want to subscribe to it. It's a very optimistic outcome. It's also one that very rarely has happened in U.S. history. And with everything that we're confronting right now and all the signs we're seeing in some of this leading and coincident data, it seems very unlikely. And finally, the last chart I have is the net interest on debt as a share of federal revenue is set to continue rising to over 20% by, let's call it 2034. But I think this might be a little optimistic of a projection. Why? Because I think that we're not accounting for how much spending is going to be necessary into the next recession to stimulate the economy, into any kind of geopolitical event that involves military intervention or otherwise. We always spend more than we think, and the only real thing that would help here is if interest rates came down, the Treasury can obviously refinance its debt further out on the yield curve to try to reduce debt since the costs further out are lower. But that's about the best they can do, and it's very likely moving forward the government's going to spend more money than the CBO projects and also pay more for it. So we are in a situation where we're not yet there, but we're approaching a time where the amount of interest that the government has to pay on its debt is going to be problematic if things don't change. Now, I think that there's opportunities out of this mess. I think that there's opportunities for us to get it together, but it's going to require having some pretty, let's say we have to make some tough choices, we have to make some sacrifices, and we have to get rid of a lot of the largesse, a lot of the nonsense, a lot of the subsidies, preferential treatment, king making, and we need to have an economy that is much more level with a much smaller and more agile government if this is to come down. So that is this week's Mayhem in the Markets. I really hope you enjoyed it. Check out the work I do over at TraderAid.com and Macrovisor.com. Each one has a free trial, so there's no obligation if you want to sign up. Check it out for 7 days. See if you like what we're doing. I hope to see you there. And check me out on Twitter at Mayhem4Markets. That's Mayhem number 4 Markets. See you next time.